Biz plan is an IRS Section 120 or Section 105 plan that helps small business owners obtain better tax treatment for their healthcare expenses as premiums and out-of-pocket expenses. And last year, this number's a little bit old. Our last year's savings was more like $5,900 average per client. And that includes small businesses with multiple owners, but it's mostly on the individual side. To give you an idea of where this concept came from, TASC is owned and operated and still privately held. We're the third largest TPA in the country, or third-party administrator. We're the largest privately held third-party administrator, not publicly traded or influenced by corporate influences, whatever that might be. But Dan Raschke and his father were insurance brokers and agents up in Wisconsin, and they also owned dairy farms. And they were looking for ways to bring the level of deduction that businesses used to enjoy, not always do now, but used to enjoy with regard to employee benefits down to the self-employed or the farm or individual business owner level. They went through the process with the IRS, got forms and documents approved, and began marketing these products in 1971, and kind of loosely. They formed the TASC Corporation in 1977 and started to market these products widely across the upper Midwest. Common household name up in farm country. If you're from Iowa, Minnesota, South Dakota, you know who TASC is. It's quite common. We have grown since the early to mid 80s through the late 90s by acquisition. We acquired a number of different products and companies that involved not just benefit plans or employee benefit plans, but it also involved compliance. And that's a whole other subject. And today we're going to focus on employee benefit plans and how they may or may not help you in your business. And I'll be happy to answer a question about that. So TASC has been at this for a long time. We're using a code, Section 105 of the IRS, that was written in like 1954. So this law's been around for a long time. Nothing that we're doing is new and inventive or smoke and mirrors. This is all well-established law, but it must be applied properly, and the controls over which and how it's applied have been expanded. So the government's reaching further down into people's lives, and we've tried to respond to that, and I'll cover a lot of that here as we go through this. The deduction for the individual plan of the self-employed works for married sole proprietors, one employee corporations, such as S Corps, C Corps, LLCs, and nonprofits. So all of these types of corporate entities can and often do participate in these types of plans. Essentially, the concept here, and again, I'm focusing on individual employers right now, just to give you the concept of Section 105 and how this works. And we'll get into some other situations that may apply more directly here in just a minute. Business owners hire their spouse as an eligible employee, or they have at least one unrelated employee. S corporations and C corps do not need to hire their spouse because the owner has a W-2 coming through the corporation. Anything done under Section 105 must be followed by a W-2, just for those that are self-employed or thinking along that line. It must be followed by a W-2. We'll get more into that a little bit later, and we can answer more direct questions to that effect. The business owner will reimburse the healthcare expenses for that employee, and they are then treated as a business deduction instead of a personal expense. Now, that's important to talk about for a minute, because essentially what you're doing is you're taking your personal medical expenses that may involve not just medical but dental. It could involve premiums for cancer policies, and heart policies, a number of different eligible expenses, which I'll give everybody a sheet here to give you what those are. And essentially it allows you to move all of that from a personal expense, because if you've ever tried to take a personal expense for medical expenses on a 1040 form, it's next to impossible to get to. You have $12,600 exclusion, and you have to have 10% of your adjusted gross income. Well, by the time you get through doing that as a business owner, you're never going to get to that number. It just never makes sense to do that on the front side of the 1040. This allows you to move it to the profit and loss statement for a corporation, or to the Schedule C under employee benefits if you're a sole proprietor. And that's a huge move, because now it reduces the overall income to the corporation, reducing your overall tax burden, which I can't really calculate, so we don't see that in that $5,000 number. But it does improve the net bottom line across the board for the corporation while moving taxable income away. It moves it to an employee benefit. Healthcare expenses, premium and out-of-pockets, are able to be moved where they become an expense deduction for the business and are paid tax-free to the employee. If that employee is your spouse, that money's going to her. This is a kind of a bucket illustration of what I'm talking about. Inside the benefits box, you've got insurance, out-of-pocket, long-term care, and life insurance. And it's $50,000 maximum on the life insurance, and it must be term. It must not gain value or have cash value in it. Long-term care policies are eligible expenses. They don't list them there, but they are, and it's becoming more and more common when talking to business owners that are getting upwards in age or may have a spouse with a serious disease. And they may have a long-term care policy in place. They're very expensive, and to have a way to be able to deduct that through the business has been extremely helpful to some of those folks. Out-of-pocket expenses, and then you see the W-2 wage. The illustration of the W-2 wage there is to show you that the wage doesn't have to be, and typically is not, the bulk of the income going tax-free to the spouse. It's coming from right here. So they're reimbursing that money to that spouse. And it makes that total what they call reasonable compensation, which is, again, a formula that the accountant will work with you with, that we provide an avenue to figure that out so that it all makes sense. Because you can't have a spouse earning $300 an hour. You've got to keep that realistic, and keeping that under $100 an hour is typically the target that we're looking for. So it just depends on what the expense level is, and then you kind of work backwards to get to an income level. Most small business owners think they're getting the deduction on their health expenses. If you're an S corporation owner, for instance, you get to take your health insurance premiums out. It's added to your box 1 on your W-2, and it comes out. Okay, and so there's no taxable income there. It kind of washes through the money. Just washes through. So that there is an S corporation does enjoy that benefit. You do not get to take your out-of-pocket expenses or some of the other expenses that I just talked about. Those are not allowed under that box 1 rule. It is strictly the health insurance premiums. So if you have additional expenses, which I'm guessing everybody in this room has additional expenses over and above their premiums, if you have those expenses, those can now be moved to that employee benefit line and become a business deduction as opposed to an expense. Okay? Throw stuff at me if you got questions, because I don't want to blow through this. The premiums that they're missing out on is self-employment tax, usually the state income tax as well on the 1040. Their out-of-pocket expenses, they usually get no tax benefit whatsoever because adjusted gross income rule, which we just talked about. And again, the average savings is going up. In this particular slide, we're illustrating $5,500. Last year's number was $59. So that number just keeps going up because guess what? The expenses keep going up. And finding ways to maneuver this under current law has been a challenge, but this is a good mathematical illustration of how this works. If you have $15,000 in medical out-of-pocket expenses, your average federal income tax rate is 15%, the state tax rate is 5%, which I think is below Indiana. Isn't that below?
That's
about right?
Mm-hmm.
And then the self-employment tax is 15.3%. If we can avoid all of those, you're going to, in this particular illustration, you're saving $5,400 on the tax bill. And this is calculable numbers. This is trackable information that your accountant can sit down and show you every year what the net effect has been in doing this. Next slide is a little bit better illustration because it shows you how this works with and without Section 105. When you have Section 105, you're allowed to take non-insured expenses, and you see where that 35% came from the previous slide I just showed you. 15% federal rate, 15.3% in FICA, and then 5% state tax. And those are pretty common numbers. The only places it's not is Florida, Texas, Tennessee, where you have no income tax. So then it's more like 28%, something like that. This is a good illustration of how that works. Because over here, you can't do this. You can't get to that number without this right here. And this makes it very, very conducive for folks that are in a sole proprietorship. C corporations, nonprofits, liabilities, they all qualify for this type of plan in some way, shape, form, or fashion. And it often requires a detailed conversation to get to that point. But if I know what you're doing and I know how you want, what you're trying to get to, chances are we can find a way to make it work. If it doesn't, I'll tell you, it just won't work. What changes may need to be made, what have you. If you have multiple employees, how many of you have got multiple employees that you're thinking about? 1, 2, 3, almost everybody. So you're ready for this part, aren't you?
Yeah.
We have one product called a no limit plan, and I didn't pick the order in which these slides come out, but I'm going to go ahead and talk about this because it's very relevant to the plan or the type of plan that we just talked about. This plan basically is a self-funded health plan that meets all healthcare market reform requirements. It's essentially a modified HRA, or health reimbursement arrangement. The largest caveat to this is there is no limit to the amount of claims submitted for premiums or out-of-pocket medical expenses. Think about that for a minute. There's no limit. So you can reimburse yourself for as much as you want. This typically is applied to families, corporate situations where you're dominated by family members. I do not recommend this, and TASC typically will not underwrite this to entities that have unrelated employees in the business, because you're exposing your business to potential bankruptcy for someone to bring you a huge claim. Okay, where this really works is in farm family situations, the logging industry. I've got several people that do that have done this. Operations that require family participation, and they need this type of deduction to keep those people viable in their jobs. And so it works very well for that purpose. I've done a number of large, complicated farming corporations that we've set up on this. That's all dominated by family members, trucking operations, hauling, a number of other things. The risk is that the potential of receiving a high amount of medical claims, and it's more of a concern to employers with non-related employees, which we talked about. The next one I want to talk to you about is probably going to hit home with every single one of you, and at least from what I'm seeing in this group. The QSE HRA, and the technical term for that, could you mind passing those out, please? Thank you, sir. The technical term for that is Qualified Small Employer Health Reimbursement Arrangement. And that came out of the December 16, 2016 law that was signed by President Obama before he left office, called the Cures Act. And the Cures Act makes it possible for an employer to reimburse individual insurance to their employees. IRS Notice 2013-54 limited the ability of small business owners to utilize standalones. It was 2015-17 that flat shut the door on it. They just came back and said, no, you cannot do it under any circumstances, no, no, and no. And that was in, I think, the beginning of 2016. By the end of 2016, the pressure was so great to fix that, to make it possible, because there were a number of employers who just said, you know what, I'm going to do it anyway. And a lot of them are still doing it. There's some relief out there for them, but they've got to get it corrected. The whole point of the expansion of, and I said this earlier, the expansion of ERISA law down into an employer with 2 employees, part of the reasoning is you've got to comply in order to be able to do this. Okay? The Cures Act, HR 34, overturned guidance in 2013-54 and again allows qualified small employers to utilize an HRA. You still have one employee biz plan type that we just talked about, the limited purpose, which is dedicated to like Medicare reimbursement. If you have an employee who you want to reimburse for Medicare expenses, you can do that. You must have group insurance alongside of it in order to do that, though. The limited purpose means just that. It's very limited, it's very targeted as to its purpose, and it must run alongside of group health insurance in order to be used. Integrated HRAs, very same thing. Integrated HRAs are basically are typically applied to employers of 100 or more who want to reimburse their employees for a certain level of their expenses collectively and have that administered by somebody like us. Okay? Let me back up for a second. In the handout that I just sent around, oh, you got them all. I want to cover a few of the key points here real quick. And there are some massive, and I call them massive because they are to me, they're quite different in terms of how this is applied. For instance, a waiting period. Originally, HRAs on the self-employed level, you have 36 months to exclude new hires. I'm just using this as an example. There are 4 safe harbors, and this is what we call them, and that is methods by which these laws can be applied. In the small business HRA, the QSE HRA, you only have 90 days. So the same factor applies to this that would apply to any other insurance plan. You can't make them wait more than 90 days to be a participant. If you're going to use this and you're going to reimburse your employees to do so, you have to let them participate within 90 days. You have to at least give them the option. If they say, you know what, I'm not interested, I don't want to do it, okay, fine, sign a document that says you're covered elsewhere, whatever, just like the old FSA, same thing. So it is not a mandatory 100% participation. It can be done on a number of different ways. For instance, you can I hate to say it this way, but you can discriminate based on age, family versus single, and insurability factors. Give you an example. 25-year-old and a 50-year-old both working the same job. You want to reimburse for premium. The employer says, I'm going to reimburse for premium and I want to help everybody. Okay, great. So if this 25-year-old, his insurance not more than $150 a month anyway. This 50-year-old who are both doing the same job, this is going to be $500-600 a month. The employer can give him an increased amount based on that factor alone. And it is allowed to do that, and it is not considered discrimination. If you have employees who are participating in the marketplace that have gone and gotten a subsidized plan, you can reimburse that premium to them. Okay? So that employee you say, I'm going to give you $100 a month. You can give those employees $100 a month, and it shows up in box 12 on their W-2 as non-taxable fringe benefit. So the employer needs to get 1 month of substantiation for that reimbursement, put it in the file. Your responsibility at that point is done. The employee is required to tell the marketplace that they have this money coming to them, and their premium will be adjusted accordingly. If they don't, it's okay. They're going to get a 1095 at the end of the year, and it's going to tell them when they were covered. Their tax person will be able to see that, and they'll also see that box 12. And then it generates a question, and it has to be answered, and it has to be dealt with at the employee level at that point. But they're able to receive that money tax-free. And you're able to take it as a business deduction if you're the business owner. Okay? The amounts are okay. They're not high. They're not crazy. The limit for single coverage for reimbursement is $4,950. The limit for family coverage is $10,000. And there's a lot of flexibility as to how that's distributed, as long as it's substantiated. If you're going to do it for out-of-pocket expenses, you have to collect what the expense is for. You don't have to send it to anybody, but you have to collect it. Okay? Anybody have any questions on this? Because I know this is hitting home for some of you.
Can you start it as, you said you have to do it within 90 days, but can you do it right at the beginning? When you
Certainly. Date of hire is,
okay.
You have the option of anything from date of hire to 90 days to decide how. You can't make them wait more than 90 days to offer it to them.
Yeah.
Okay, so anything that TASC does, including this, with regard to small employers, has all of the necessary DOL compliance paperwork that's required comes with this. So you don't have to go out and worry about your ERISA compliance or what you're doing isn't fitting into somebody else's idea of what you should be doing. You get all of that from us. We actually take care of the summary plan description, which is a critical document, and we construct and maintain the plan document itself in our home office. In the event that anybody should ever come to you and ask, we have that. The SPD, or summary plan description, is what you need in your hand when you're talking with your employees about this or distributing those benefits to them. Okay?
Kevin, what about tax reporting, 5,500?
There is no tax reporting with regard to this. If you have less than, right now it's 50 employees, you are not required to do a 5,500 on these plans. As far as I know, you're not required to do 5,500 on any of them. TASC will do them when and if they're ever required. We do 5,500 filings for a number of companies. We do ACA reporting. If you're having issues with trying to track your ACA reporting, and I can't imagine why anybody would try to tackle that themselves, but if you do, you might want to look into having somebody come out and talk to you about it. It's well worth the money to have it done. If you're not in that situation, if you don't have at least 50 employees, you don't have to worry about it.
Kevin, we made some variations to this plan for ourselves.
Mm-hmm.
I know you've given those limits, but would this be a good time to talk about what you can do with, say, exempt and non-exempt, and the way you can do these classifications,
yes,
classifications of what TASC will do as far as these limits?
Yes, some of the issues or situations that I run into involve we have a number of employees and we want to do different things for different people. We just, we want to, you can do that to a degree. You can do it with regard to the limits that we talked about. You can do it with regard to age and insurability. Those are written into this, and it's very easy to do that. And I told RBSK this. There are no laws against having specific delineation of benefits. You have to be careful how that's applied. So you have, in other words, what we were talking about is they wanted to say, we wanted to have, can we identify the benefit by classification? The answer is yes. If you have exempt employees and non-exempt employees, and typically that's going to be the difference between salary and hourly. That's just a common distinction. Those classifications can have separate entities as far as the level of benefit that they receive or how they get it. Now that's something that you may have to administer internally, but there's no rules or laws against making those decisions and then delineating that down to the employees. It's a form of compensation. If any of you had employees that you were reimbursing and you stopped, or you brought them in and said, hey, we just need to turn this into part of your payroll now because they won't let us do this anymore, so I'm just going to add it to your paycheck. It is reasonable to have a conversation with those employees and say we want to renegotiate that back to tax-free status. Would you be interested in doing that? You can't require the employee to do it. You can't take the money away from them once you've done it. But you can restructure that money to a reimbursement which gives it to them tax-free. I have yet to do any of these and say that to a group of employees and have them go, no, I'm not interested in doing that, because it lowers their tax bill. Okay, now they may end up paying some tax on that money at some point, but they get to use it for the whole year. At the very least, they get to use it tax-free until they have to report it at the end of the year, which generally they don't even see it. They don't even know. So.
I have a question.
Sir?
So we had an HRA program before they said we couldn't do it anymore.
Right.
And we did exactly what you're talking about.
Mm-hmm.
We still wanted to give them the money,
Mm-hmm.
so we adjusted it up for the tax part of it, if you will,
Yeah.
and paid it to them as a separate payroll line item.
Yep.
So they wouldn't forget that it was a benefit.
Correct.
Okay. So one thing that I understood before, though, is that if you did it for one, you had to do it for everybody, and it had to be the same. But it sounds like you're saying now that they can opt out of it. And in one case, we have an employee who isn't interested in it as an HRA because through his wife's work, they get 100% of their medical paid even out of pocket. So
Okay.
they have no use for it whatsoever. It just builds up in there. So he got a big payout, when we had to pay out the balances in the accounts, but because we carried them over. So am I understanding that correctly, that employees can opt out of this program and
Yeah.
not be part of it?
Typically, the problem with it was before, if you had an employee participating in or not participating in anything, and you bring something in, and you all had this problem where they were getting ready, they were asked, many employees were asking, do you offer group health insurance? Because if you do, I don't want it. Well, the law back then wouldn't let you opt out. If you had group offered to you at your employer, you had to take it.
Mm-hmm.
And it messed them up with their spouse's coverage, which in often cases was much better. And so those level of mandates are being looked at and being written off. They're taking
Mm-hmm.
those out. Regardless of what the Senate does at this point, that's going to go away. There's
Okay.
going to be a lot of those mandates are going to go away. But at this point, what this particular arrangement says is that yes, you can set up delineation, and if someone, it's voluntary because you're under 100 or you're under 50 employees, that mandate still stands. But you're under 50 employees, you're not required to do that. You're not required to offer the plan, and if you do, under these circumstances, you can discriminate, and they can either opt in or opt out.
So is that just for this particular one or the HRA in general?
No, it's going to be strictly the QSE HRA, the qualified small employer.
Okay.
Now, the standard biz plan would have to be offered. Let me just give you a couple examples. You had 5 employees or 10, so you got 10 employees, and you want to set up a health reimbursement arrangement. By law, you have to offer that health reimbursement arrangement to all of them.
Offer though.
Correct. You have to offer it to them. They don't have to take it, But they have to substantiate that they have coverage elsewhere. Okay?
Okay.
They need to do that, because that puts you in a bad situation if they don't take it and they're not covered somewhere else. What are you doing? I mean, not you, but what's the employee doing?
Yeah,
And so then the question is, why didn't they participate in that plan? It's free money. Why wouldn't you do that? So again, they can do what they want, but the employer is the one who's responsible for showing DOL if they come in there and ask, why isn't he getting that money? Well, he said he didn't want it. See? Oh, okay. That's an argument. I mean, that's a reasonable argument under these conditions. Okay? Now, go ahead.
And what if they do not have health insurance? We've tried, we're a small employer, we've tried to get group insurance and we can't compete.
It's too expensive.
Because we're under 50 employees.
Sure.
So we can't get a good rate on it. So, which is why, but we wanted to do something, so that's why we, tried the HRA to begin with. I do know that we have at least 2 employees who have no health insurance right now. And I continue to encourage them to get that, and for lots of reasons, but at least, I mean, for one thing, they're getting penalized on their taxes. But still, for them, what they say is it's cheaper to pay the penalty than to pay
And
the
that's going to be
premiums.
true in some cases. You can't do anything about that. If
But
they
you're
wanna
saying
opt-
they have to have, if they opt out though, they have to have coverage elsewhere?
They don't
But then,
have to.
but
They
then
need
they
to
have
sign
to
a
have
statement to
minimum
you that they want to
essential
opt
to,
out. See what I mean?
I'm sorry?
Oh, I'm sorry. They have to opt out on paper.
Yeah,
Now,
I'm just,
That doesn't expose you just because they decided to opt out and don't want to carry insurance. The
yeah.
individual mandate is part of what's going to go away as well, I think. I mean, at
Well,
this
it
point,
should,
they're in the
but-
process of moving it in that
Yeah.
direction. And so that is an individual decision, but, this is designed to give the employer some flexibility.
Yeah.
Let me address your question a little differently. That employee, I would then say that if they don't participate in this, then how do you pay for your medical expenses, Mr. Employee? And what are you doing to pay for this? Well, I just pay for it out of pocket. Okay, well, wouldn't you prefer to do that with some tax-free money?
So they can do that if they don't have insurance, they can.
If your plan is structured to be an either or, premium or out of pocket,
I see.
you give the employee the option. The
Okay,
employee can then take the out-of-pocket option, and you can set that amount and give it to them, and they're good to go.
okay.
So the plan can be written to accommodate both premium, I didn't quite get to that, but it can be written to accommodate both premium and out-of-pocket expenses. And that's a good thing.
Mhm.
Anybody else? Or is you the only one that was reimbursing? Was anybody else doing that before? No? Okay. I
Is
just
it
wondered.
45.9 include the the insurance premiums? Is that your
49
limit?
49.50
So
is.
insurance premiums, out of pockets, 49.50 is the limit unless you're 10,000 for a family.
If that's how you set your plan in place, yes. If you want to give everybody in the place $10,000, you can go to that limit. It would then become a combination plan. So you have $49.50 for single premium, and then you can have the rest of it for your out-of-pocket expense. Does that make sense?
Mhm.
Kevin, for example, what if we want to go to 30,000?
There's some debate right now in the legal community about whether or not the government has the right to draw a limit on that Section 105 code, because in the law, the employer is allowed to set the limit of liability they're willing to accept. That's what 105 reads, and if you read the document, that's what it says. That the employer decides the limit of the liability they're willing to accept. The government is placing a limit on the liability you can accept in this plan. And so what TASC is doing is we're honoring the request, whatever they are. If it runs over, if a guy ends up with $12,000, $15,000, the employer wants to reimburse it, we'll accept it and we'll back it. We'll administer that. In many cases, what we're doing though, honestly, is we're providing the legal framework, and the employer is taking on some of the responsibility of administering it, A, to save money, and B, because they want to have a variety of options available. So they're willing to do that. In the event that you had an out-of-pocket expense fund, let's just talk for an out-of-pocket expense fund for a second. If that's all you had, TASC would issue debit cards that look like any other credit card that you get. And it's called a MyTASC card. The card can be used at any medical provider. You can't use it at the liquor store. It will know you're at the liquor store. Okay?
Oh, darn it.
Well, I got that prescription for a bottle of wine. It's not good anymore? Oh, shucks.
Man.
Shucks.
Darn.
That's why you always had liquor at the pharmacy, right?
That's a killer. They all want to go home now. So, but no, it knows where the person is by merchant codes that come out of the point of sale device. So that code comes to our server and it knows where you are. Okay, it knows if you're at the pharmacy at Walmart or if you're at the front counter trying to buy clothes. It knows where you are. Okay, so that card then can be used for out-of-pocket expenses and prescriptions. Let's just say that. Okay. What happens then is that there's a reimbursement that takes place in about 2 weeks. That TASC will do an EFT out of the business account, which saves on administrative time of you all collecting claim information and processing it and trying to do any level of determination on it whatsoever. They simply take that card and use it. Now, when you get to 10,000, the only internal administration that has to be done is somebody has to be watching your TASC account, which we provide an online, all web-based portal that you can go in and see what's going on your account at any given point in time. And it's going to be up to date within a few days. It's not going to be out a month, 2, or a week, anything like that. It's going to be pretty up to date. And so if you have an individual who's running those cards and he runs over, he goes out and has a filling or something done and it costs $500 and it ran over his total for the year, TASC is not going to reject it. You have to turn that off. You have to call us and say, hey TASC, Johnny Doe just ran over his total, turn his card off. We turn it off. Okay? TASC is in the process of becoming a card processor. We're buying a processing company. We'll be able to do that on our own. But right now it's just extremely difficult with all the foul-bound information it has to communicate with the card processor to be able to set those cards to say, RBSK has 12 cards, those 12 cards have a $10,000 limit, we want you to turn it off at $10,000. For a company this small, that's next to impossible to do. We've got 1.5 million cards out there flying around the country. It's impossible to do that. If you have 500 employees, we might be able to fix that. So it's just an economies of scale kind of thing. So now there is a little bit of administration involved if you're doing out-of-pocket expenses, but the life insurance is easy. It's a line item entry like you were talking about. It's a line item entry underneath the tax line, and it goes right onto their check, and it's tax-free money. And then it comes onto their W-2 at the end of the year. So, this is a huge step forward in trying to get back to allowing employers to actually have some control over what they're doing in terms of a reimbursement as opposed to trying to find group insurance. Or having the expectation that their employees are doing it on their own with the money you gave them and put it in payroll. You know what I mean? They're just not doing it. Most of them they'll just bite the bullet and pay the fine.
Do you also have to pay, if you do the life insurance, do you have to do that for everyone and offer it to everyone? Or can you do the classifications on that as
The
well?
QSE HRA does not facilitate life insurance premiums. That is, as far as I know. We don't, that's not part of the QSE HRA. It was not written to include that.
But the other one is.
If you are privately employed and you want to take a standard biz plan or an agri plan, HRA, yes, you can include up to $50,000 in term life insurance for the
Oh, yeah,
employee.
you said term.
I was going to say, now you just said the magic word, because I was going, when do they make deductible in life insurance? Because that, if you could make that come true, all of us would be selling life insurance right now, I'll tell you that.
Yeah. No, they probably won't ever do that. And again, they're very particular about the fact that it can't be a policy that derives any value whatsoever. It must be true term life insurance. And it's strictly $50,000.
Kevin, one of the risks that we identified and we've talked about is say we've got a $10,000 unreimbursed medical. Say the employer doesn't kick anything. It's just basically they want to reduce their salary from $50,000 to $40,000, and I'll take the other 10 and out of pocket. They plan a surgery. So this plan starts January 1. They plan a surgery on January 2nd. That costs $12,000. So they go in, they write a check to the doctor for $12,000 on January 2nd. They're in your payroll office on January 3rd, said, I need my $10,000. You're going to give them the $10,000, correct?
Correct.
You're gonna give it to them, or the employer's
But
gonna?
the employer,
Oh, okay.
The employer's
Darn
gonna
it,
get
yeah, I
Just wanna
thought
make
you were
that
being
clear.
generous.
Yeah.
Somehow it's gotta come out of your pocket.
My point
Yeah,
is
that's
on
fine.
January 4th, they get a better offer to go work across the street.
Yeah.
that's called universal coverage.
So I just wanted to point out that there's a risk there, and we've done some things to try to minimize that risk.
Yeah, the universal coverage rule exists in any and all of these types of plans, including Section 125, which is where that rule came from. The insurance carriers required it in order for the TPAs like us to integrate and to work with them to help them to handle claims and process and things like that. So they required the application. It used to be $2,500 as a limit on flex system. So you take a $2,500 contribution, whether it's by the employer or the employee. If they wanted $2,500 on January 4th and they had a substantiation for that claim, you had to give it to them.
Even if it's not built up in their
Yep.
account.
Exactly.
And even if it's strictly employee contributions, you still had to give it to them.
And
Okay?
it's still like that? I mean,
Under
because
Section
can you
125, it's
imagine if
still
like
that way.
3, 4, or 5 employees did that?
Well,
I mean, my
nationally-
gosh, I don't have that kind of money just laying around.
The statistic on that is less than 5% of the employers across the country
Right.
experience any negative reaction to that or any negative experience with it. This doesn't happen that often. Primarily because it's not a heavily advertised element of Section 125.
Well, I'm sure not telling my employees about it.
Well, exactly. Some of them will go and find out. You know, they'll go to websites, they'll ask, what are the rules around 125? How many of them actually know to do that? But the reality is it's there, it is a requirement, and it's the same is true under this type of plan if you offer that as an out-of-pocket expense reimbursement. So that universal coverage rule is important to the employees, but at the same time, again, in terms of small employers, I've been doing this for almost 6 years, and I have yet to have one where that's happened.
So, see,
So it just doesn't happen that often.
Before, we just wouldn't let them go over the balance in their accounts.
Right.
You know, I mean, because we tracked it.
You can still do
We had
that.
less employees like that last time, but you know, we everyone had their own account. We knew exactly what their balance was
Mhm.
based on what we put in every month. You know, what they took out. So, but that's not the way it is now. So, are you saying is that something different, or is this something that
No,
is
you
the
can-
same and I just didn't know about
No,
it before?
you're doing an internal administration, and that's fine. I mean, there's nothing wrong with that. You're doing that on spreadsheet.
No, I mean, as far as, you know, if we put a certain, let's just say it's $300 a month, we put $300 a month in there, so for the year, that's like $3,600. But they couldn't get $3,600 out in January because they only had $300 in there. You know what I'm saying?
Mhm.
So we would not have let them make it a negative balance because they didn't have it.
Under the rules, that's not how it works. Okay, so-
Well, we didn't know that.
That's okay. Not, nobody's done anything wrong here. We're just
Yeah.
talking, so. But the realities of that universal coverage application rule is there. It's always there. It's
Okay.
always gonna
Wow.
be there.
Okay.
Yeah, one of the things that we're considering is placing a limit of 1/12 a month. You can pull out 1/12 a month.
The key to that, John, is the fact that you all have said it's not gonna be a use it or lose it. You're not gonna lose it.
You're not gonna lose it.
At
So
the end of the year,
nobody's
We did
gonna
that
lose
too.
their
you get the
money.
money. Yeah, that's the only
Well, we
reason.
didn't, so if it's still, if they have a balance at the end of the year, you're supposed to pay it out to them? We just let them roll it over to the next year.
You can do that. That's an accrual. And again, HRAs are typically set up so that you aren't really putting money in there. It's just you're keeping a running total of your
Right, it's
contribution.
just all,
And when they come to claim, it's when you actually pay it out.
right,
which is good.
exactly, yeah.
And so, yeah, you
It's all
can
on
roll that
paper.
into the next year, or you can use it or lose it. In
Yeah.
other words, if you don't use it, you lose it. If not, I'll pay it to you. But carry forward, no. Because some employers would find themselves very quickly in a situation with somebody who's acquired $15,000-$20,000.
Mhm.
And
Unfunded.
that's not the best thing to do sometimes.
Unfunded.
Unfunded, exactly. So you have a mandate out there that is now a liability to your corporation. So most of the ones I'm working with are deciding, you know what, we'll just pay it out. Just give them the
If you
money.
pay it out though, that part's taxable, isn't it?
It
If it's
is.
not for medical.
It is. The corporation will escape FICA. That's the
It
only-
will- the corp-
escape FICA. Yeah,
Oh,
I'm thinking
okay.
that, will they?
You don't have to
Escape
pay
FICA?
I know,
FICA
it's
on
just gonna be
that?
a regular W-2.
It's gonna be a straight up W-2.
Straight up W-2.
Okay, so it would
So
be
if they got
just a-
1,000 left, you're just gonna do a $1,000 gross paycheck.
Right.
So instead of electing 9,
Oh,
or
there-
10, they
there
elected
you go.
9.
Okay.
Yeah,
Yeah.
okay.
And then you can, I think what we're talking about was giving them a limit on the rollover. So you can roll over, but only to like 5,000. You
Okay.
can't go, you can't have over more than 5,000 rolled in
That's
next,
okay.
because we don't want to build up this monster liability. Otherwise, it becomes almost like a deferred compensation plan.
Yeah.
Well, if
So
you don't
you
have
can-
in any kind of insurance program, they're gonna eat it alive just paying insurance.
We did have
Cost.
people that had some pretty good balances.
Depends on your limits.
Before when we had to.
That's why we're
stop
talking about, can
doing
you
it.
make better limits?
So you can though set it up to where you kind of have an internal policy in your company where they can only take out, like you said,
1/12
1/12 per
If you want
month.
to administer that, yeah, you can attempt to do that.
Yeah, we're gonna administer it
It has to
ourselves.
be done equally across the,
I don't see any reason why
Whole
we can't
spectrum.
administer ours, because, I mean, we don't,
It's a
we don't have-
spreadsheet.
it's not like, right,
Right.
we don't have like,
See, if you were-
49
if you were
employees
affili-
or
if
something.
you were
49.
Even if we did, I mean. it's gotta
If you're
make us
affiliated with a
different.
group health plan, you couldn't do that. Because you're,
Couldn't
if
administer
it's
it yourself.
integrated with a group health plan, you've got to match the universal coverage rule. So
Yeah.
if you're
No,
not,
we
if you're
don't.
reimbursing just for out-of-pocket expense or premium, then you're not involving group health insurance, and you have the option of doing what they're talking about doing,
Okay,
as far as distribution of
that's
the
what I
money.
need to know.
When you have an individual proprietor, you mentioned the 1040,
Uh-huh,
and I think that was the biz plan.
correct.
You're telling me that they can write off their expenses, their medical expenses?
Give
If
me,
they're
let
individual employer,
me give
one
you,
person, I mean, just me, the proprietor?
correct. Now, I'll tell you how that works.
What's
Let
the
me give you
difference
two
between the
scenarios.
105 program it used to be?
I'm sorry?
What's the difference between that and the way the 105 used to be? Was it, I'll give you X dollars
For
reimbursed
single
to-
employer, it has not changed.
For a proprietor, I mean, for somebody that's in a, one person.
Okay, that rule still applies for them. They can, this is the same way it used to function across the board. Okay, you can't do that with multiple employees,
No.
but you can as a single entity use those rules
Well, I've
because
seen
they.
it with S corps, but not from proprietorships. I'm not seeing.
Okay, Schedule C, sole proprietor. He's gonna employ his spouse.
No.
Yeah.
Don't have a
Can't do
spouse.
it, can't do it.
Okay,
Yeah.
that was the point I was about to
Yeah,
make.
you
do Unless- that. unless you have-
I said single and no
Right.
employee.
Yeah, we've got to
No
hire,
employee,
we're hiring
no
a
You gotta,
spouse
you gotta
or-
hire, you gotta have a W-2 is what
That's
the
right.
phrase was.
That's
Okay.
right.
Correct.
Just wanna clarify that.
Yeah, that's why we are now doing a lot of payrolls that have a single employee.
Dear, boy, it was nice that you came into work today. I got that.
Could you get me a sandwich?
Yeah, that's right.
The biggest questions
Like
that
in
I
the
get.
junior, empty the trash packets in the old days.
A lot of the questions that I get centered around single employers are more geared, and again, this is just because of the nature of the clientele that I have, is more geared toward the formation of partnerships and LLCs and things like that are underneath a corporation that a farm owner. This is a farm conglomeration going on. And they have a number of entities and interests and things that are happening, and they want to know, can I do this down here at this level without disturbing what's going on up here or creating a problem? And that's kind of where I have to get in and think in terms of talking with the CPAs about how they're set up and what they're doing. But invariably, the single employee, the single sole proprietor, if he's an S corp, he's got a W-2, I can do him all day long. If he's a sole prop, just file a Schedule C, he must employ a spouse or an unrelated employee. There has to be a W-2.
Single member, same way. Single
Correct.
member LLC.
I have another question. So, I have a company that employs under 50 employees, and then I'm also part of an LLC. That one is an S corp, okay, the one that employs him. Then I'm part of an LLC also. So can I be a member of a plan in both entities?
Yes. You can't be a member of a plan in your LLC all by yourself and do nothing for that S corporation. That's a no-no. Okay, that is going to draw the attention of the IRS wanting to know, why are you taking your personal medical expenses over here, but you're not doing anything over here? This is where your primary source of income is it not? The S corp?
Yeah,
Okay, so if that's your primary source of income, you want to be clear to the IRS what you're doing. So if you're
Right.
offering a benefit to your employees through this S corporation,
Mhm.
like the QSC HRA,
Yeah.
and you want to have your own over here,
yeah,
you can't. Owners can participate in the QSC HRA, but
Right.
you participate to the extent of the limits within the plan you design.
yeah, right.
But you
Which
can
is-
do both if you wanted to. I have to be very careful about how I tell people not to do that sometimes,
Yeah,
because they can, but I have to know what's going on. I have to know what
Mhm.
you're doing where, and I don't want to create a situation that's going to draw attention to
sure, right. I just wonder because it's just a way that I could potentially maximize my benefit
I
tax
do it
free.
every day. I do it every day. But again, we have to make sure that all the ducks are in a row and
Right.
that we're doing things the right way.
Okay,
Okay, there's some ethical issues there. Flexible spending accounts is something else that TASC does. Section 125 plans, or for lack of a better term. If you have, it allows you to do pre-tax dollars. It's also known as a cafeteria plan. It involves medical, dependent care, transit, parking. We don't have parking around here. Transit's not an issue here either. So mostly it's just dependent care and medical expenses. You're going to save between 25 and 40% just on that tax-free money. It must be coupled with a group health plan. You cannot do standalone FSAs. We used to do those, can't do it anymore. So if you don't have group insurance, you cannot have a Section 125. If you have group insurance and you do not have a POP or a premium-only plan document, you're in violation of ERISA and DOL. You must have a POP if you have group health insurance. And all that is a Section 125 plan document. Now, if the employer, I'll take that back, if the employer is paying 100% of the cost, then you don't need a POP if you have group health insurance, if the employer is paying 100% of the cost. If you're asking the employee to pay a portion of it, you have to have the POP or the 125 plan document in place. Now, with our POP, we also issue a wrap document to include any other ancillaries like AFLAC or life insurance, dental insurance, or anything like that that's going through the group. You need a wrap document to cover all that, and that's what that POP does. There are also some ERISA requirements, and there's some HIPAA requirements and some stuff. If you're going to administer, just for instance, to touch on your situation, if you're going to administer plan reimbursements,
mhm,
you need somebody certified HIPAA. I would strongly recommend that. You can get as many people as you want certified HIPAA for $100.
okay,
It's $100 a year. It's the best money you ever spent, because if they come in, they'll hit you with a $5,000 fine if they find you mishandling personal information. Okay? And it's just not
Mhm.
worth it. So if they ask, who's your HIPAA cert?
mhm,
Right there. It's Susie.
okay,
That takes that a lot, and that'll make that go away, because they understand, you need to
Awesome.
understand what you're doing. They'll look around a little bit and make sure you're not, violating it, but they want to know if someone in the entity is certified for HIPAA handling and
where do you get
personal
certified
information.
for that? Okay,
TASC, there are a number of companies that do it.
yeah,
But TASC is one that'll do it. We'll certify as many as you want under one EIN number
okay,
for $100. And it's $100 renewal, a year renewal, and I would strongly suggest that you keep it.
100 per person or total?
It's 100 total for as many as you want. You gotta do them all at once.
Okay, yeah,
And it's basically a live webinar. And they
Oh,
go
okay.
through that, and we provide them
I was
information.
gonna say, that'd be some sort of education to go along with that.
Yeah.
sure, sure, yeah, I figured.
Yeah, we don't just mail it to you.
Yeah, I want to
That's
be
for-
the Reverend of the Church of the Moon or something. I sign that up and go, but that's not like the same thing.
That's right. That's exactly right. All right, this is something else. The task card is what this is going to talk about here for just a second. All of these plans that can be added to, it can all be integrated into this, the use of the task card. And the reason I talk about it so much with clients is because it is such a huge tool in terms of administering what you're doing. And it clears you all from making mistakes. Because all Joe Bubba's got to do is go down to the pharmacy and swipe the card. He doesn't have to bring you a receipt. He doesn't have to wait for his EOB. and bring that in, and you don't have to go through any of that. He just uses a card. When you hit the limit, somebody's watching it, call TASC and say, TASC, turn Johnny's card off. He hit his limit, I'm done. When it goes out next year, you can reset them all over again, depending on your plan day.
So if you self-administer, you wouldn't have this?
If you self-administered, no, you would have no reason for those.
Okay.
That's there as a convenience factor to the employer more than anything else, in terms of accounting and administration.
If you self-administer, then the employee is gonna have to pay and get reimbursed.
Correct.
So that's the one
Okay.
factor.
That's how we did it before.
Yeah.
And they can't go over that way.
And most of the employers I work with would rather do that. It's the really small ones and the family operations who love that card, because it makes their job so much easier.
Yes.
They don't have to try and keep track of it and then pack it all up and send it to TASC.
Is there a per transaction limit?
No. Oh,
It can be set on there?
$2,500 is the maximum that the card holds. TASC preloads the card with our money. And then when they use it, it's there, so we don't have to tap your account at the point of sale, but we will send an email to the administrator and it'll say, on this date, you had this transaction for this amount. And it'll tell you in about 48 hours to 72 hours, on this date, we're gonna EFT that amount out of your business account. So two things are happening there. Number one, you're getting an administered process that creates a deduction for you, the business expense, and you get a paper trail for what's going on.
And you would know which employee it was also?
Absolutely.
Can you
Absolutely.
use that as a method to protect against that, the $12,000 medical expense they incurred and then leave a couple days later, or is that, can they just go 2,500, 2,500, 2,500? Or?
No, that's a good question. No, it's strictly 2,500 at a maximum limit. And until that amount's reimbursed, let me give you an example. Say a guy's got to go get a test done, and it's going to cost 3,500 bucks. Well, he can take that card and pay for 2,500 of it. That's as much as it'll do. Period. Stop. Over.
So wouldn't that be a method of control?
Yes.
Okay.
How do you protect?
Quite indirect, but yes,
Yeah.
it is a method of control.
How do you protect yourself with 2,500? Do you have an account that's automatically charged to the employer? You don't advance 2,500 bucks and then get reimbursed by the employer,
Yeah, we
do
do.
you?
Yeah, they do.
So you're out of pocket that? Okay.
That's the only way small employers can do this, is to protect their cash flow. And that's what we're doing. We're basically protecting their cash flow from themselves because they're trying to help their employees. This is at least gives them a trackable warning system. You're going to have this expense and it's going to be for this amount on this date. So we're telling you what's happening. You got a question?
Well, but you load $2,500 on there,
Mhm.
and if they use the $2,500 today,
Mhm.
when do you reload it? When the employer tells you to? Or
No, we'll tell you when the transaction took place,
Mhm.
and then we'll tell you when we're going to do the reimbursement, the EFT, because we need your bank information.
No, I'm talking about, okay, so you go through all that for the first.
Mhm.
Say you got a $5,000 limit or $10,000 on each employee.
Okay?
You do $2,500 first.
Mhm.
And then a month later, will there be another $2,500 that they can use on that card that they have?
Within about 2 weeks, actually.
2 weeks. okay.
Even before it's reimbursed by the employer?
No.
That's what I thought. So I think that's your question.
Well, I just wonder
Yeah.
because, like you use the example, they do a test for $3,500 and they go pay $2,500 on that card. Well, they still have a balance of $1,000.
Correct.
They want to use that card again. How soon can they use it to pay the balance on that $1,000?
Couple weeks.
Couple weeks. That's what I was asking.
Or you
Okay.
come in there and say, stop.
Or you come in there and say,
Yeah.
stop. Yeah,
The
don't
employer
put
tells
any
us.
more.
Yeah.
Stop.
Yeah, don't put any more on that
Correct.
card. Okay. All right.
How do you
Yeah.
make your money off of that?
We don't charge for that service at all. We don't charge anything.
It's
Okay.
built in your administration fee or whatever.
Correct. Okay. The QSC, let me cover that for a second. The QSC HRA has a startup administrative cost for the plan development of $475. That covers one employee. Each additional employee is plus $90. That is an annual fee. It is not a contract. You aren't hooked in for 10 years. Okay? It's like any other group insurance or anything else that you do. It's good for as long as you do it. Okay? So it's $475 for the base plan, which creates the summary plan description, the plan document, and the administrative processes. Okay? And then it's $90 per additional employee beyond that.
Per year.
Per year, that is an annual fee, yes.
Even if you self-administer?
Yes.
Okay.
Like I say, we don't charge any fees for the card. We don't charge to issue the card. The only time we charge for the card is if somebody wants more than one.
What if we didn't use the card?
No change.
It's still the
Because
same
we don't
charges?
charge for that service. So it's, I mean, basically the card is free whether you use it or not. So the $475 is for administrative setup of your account, establishing the legal framework and the documents and getting all that together. It includes the card if you want it, but if you don't want it, it's okay.
So if it's for setup fees, why do you charge it every year?
It's an administrative fee, not just a setup. It's an administrative fee. So we have to reconstruct the plan document each year. And we're required to do that by law. We can't avoid that. Let's talk about that for just a second. I got approached by a group of attorneys, and I didn't know what to think about this, because you know how attorneys are. But I got a call from these guys, and they basically said, look, we used to do a lot of MRPs. There was old medical reimbursement plans. And they were like, we can't keep up with it. We can't keep up with the changes. We can't justifiably charge our clients what it costs for us to rewrite those documents every year, now that that's required. We want you to come down here and take care of this for us, because we can't do it. We just can't afford to do it. And you know, they did some research and they selected TASC as a company they wanted to use. So I went down there and was working with about 4 or 5 of them, and we were just redoing MRPs that were documents that were probably 15 years old, that they just stuck in a drawer and left there. And you know, prior to 2013, that was perfectly legal. But as of 2013, all that went away. And that's not an aspect of Obamacare that's going to get changed. That's an under the carpet regulatory thing. Just like the ERISA rules that dropped from 100 employees to 2. So, we just talked about all that. The MyTask online tools are important. We've kind of been talking about this. Okay. And you know, all of this is available online, year-end reports, service requests, track your service, or you can call us directly. And I mean me or my assistant, because that's typically how I do it. One of the things we will also tell you is that we're audit guaranteed, and that all of your ACA healthcare reform, anything that creeps into this from that aspect, we'll back and do a hold harmless on it. So we stand behind all of this to protect you in this whole process. Anybody else?
Very good.
All right, perfect.
Yep, I think we're right on an hour, so Kevin's not gonna run off. But we're gonna conclude at least the hour, so if anybody needs to go, I wanna give you the chance to do that. You're welcome to stay. And good conversation. I appreciate Kevin coming. And we'll welcome to the cookies and refreshments. Welcome to the door, let a little air. If you need a restroom break, I'll show you where those are, but you feel free to continue the Q&A. So thank you.
Yeah, any questions or subject matter you want to kick around, I'm happy to do it.
I don't see how that fits into health savings accounts.
Health savings accounts?
Yeah. 'Cause
Health
I think
savings
that-
accounts and HRAs are similar, yet they're different. Okay, they're similar in that there is tax-free benefits to both.
We do.
I don't ever tell somebody, you know,
I knew you
HSA,
was worried about that.
okay, but there are limitations. The HSA is limited as to what you can use it for, how much you can put in it, and how and when you take it out, supposedly.
Well, I'm thinking about just your deductible. That's an out-of-pocket cost,
Right.
your
Okay.
deductible.
Right?
And if you can't reimburse the deductible, the health savings account, then you've got to switch to something different. And I'm trying to figure out how, because I think health savings account is one of the things you're going to see a lot more of with the Republican administration.
You're very
And so,
accurate.
and if they got to lift this stuff, the restrictions Obamacare had was what killed that particular aspect of it. You've got variety here,
Right.
but it's not complete replacement of the old health medical savings plan.
Well, the health savings accounts are going to be drug pushed, rolled, whatever you want to call it, more toward the individual. And moved away from, because what a lot of companies and executives are doing is using
Well,
it
it's an
just-
individual account. You have to get a group policy to get your major coverage, but everybody has their own, it's portable, they can walk
There
away
are
with it.
administered HSAs out there. Follow me here,
Okay.
because a lot of companies are paying huge amounts of money into HSAs, and executives are leaving and taking that money with them.
Yep.
And they ain't using it for nothing, except money.
No, that's one of the things that is good for the employee. If anything is put in there, whether it's employee money or their money, it's their money. If they
Right.
walk away, they take it with them.
Right. Now, the
It's the
reasoning
same with
behind all that,
HRA though, isn't it? It's their money once you put it in there.
well, you don't really putting it in there. You're not putting it in there until they
Well, I
use
know
it.
it's virtual, but that's what I was told, that it's, once you fund it, I know it's on paper, but that
See,
it's
you
their
allocate
money.
it.
That's an old amount. You allocate it, but you
Yeah.
don't fund it. The
You're
old days,
allocating
you
part
had
of
to
their
fund the
compensation
HRA.
package.
You had to fund the HRAs in advance in the old days. You had to put 50% of that. If your expectation was $100,000 a year, you had to put 50 in the bank and let it sit there.
Mhm.
And then you had to fund it as the TPA told you to, just in case you had more expenses. But so you don't do that with this. QSC HRA doesn't operate that way. It is strictly a paid out as it's used. So the cash flow of the company is much more protected.
Yeah.
Same thing with HSAs. If you're, they're paying that money out in payroll, tax-free to the employee, it's going into their bank. And they're just letting it sit there. And there are a lot of guys out there making a living in the investment industry
Oh, no.
telling people, leave that money there, just leave it there, we'll roll it into something after you retire. See, because there's no monitoring on that. The bank doesn't have to report to anybody. All the employee has to report.